The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. It's Doug. Glad to see you all here. If everybody could just throw a Y in there, if you can see my screen, hear my voice, you know the drill. Y. Okay, got a bunch of Ys. How are you all doing tonight? Glad to see some people in here. Good amount. Some more people rolling in as we get started, as always. I'm doing okay. Attican, thanks for asking. I'm feeling a little under the weather, so I might not be as energetic as I normally am. I apologize in advance, and I might have to mute in order to cough, but I'll see if I can give it my all, give you my best performance that I can, right? Okay, so let's just get started right away. I believe that's the hotkey. There we go. Okay. But you all know the drill, right? But we got to do it. So nothing presented in this webinar, the video presentation, vocally or visually, is to be taken as trading advice. You should all know that by now. You know, everything in here is for educational purposes only, and any trades taken which are influenced by any of this advice and education is completely at your own risk. And please do not trade with any money that you cannot afford to lose. Okay. So let's get rolling right away because, you know, we're short on time now. There we go. We're sticking to 50 minutes, right? We want to get as much information to you as possible and get you on your way. So this is about when to hold your trades, how to hold your trades, okay? That seems to be one of the biggest problems that people have is gee, how do I know when to get out? You know, you talk about the swing all the time and when to get in, but like, how do I actually know? Like, I don't know, and the pullbacks scare me. Like, how do I know where the maximum it's going to go? How can I lock in the most amount of profit? So that's what we're going to talk about tonight. Actually, let me just dock these questions. I'll get to them shortly. So, when to actually get out? Now, a couple things that I want to cover in regard to all this. Just three disciplines that you want to focus on and that you have to consider, that you have to factor in regard to, like, okay, I'm in my trade now. Where do I go from here? Like, well, okay, now what do I do? That's the technical, the mental, and the emotional, which is, I mean, that's many presentations all wrapped up into one, but we're going to try and get that covered today, and hopefully in the future I can elaborate on that. And of course the behavioral. Now the behavioral, I don't mean your behavior, okay? I mean the behavior of the market, the price action. So you need to really factor in all of these, and we're going to cover each one briefly. We're going to get to some charts. We're going to look over all this stuff, but it's not just, I want you to understand, it's not just, hey, when you see this, just you get out at this point with this exact pattern and on this retrace and over here. There's some general guidelines, but it's a lot easier, I think, to designate several rules for, you know, hard, fast, in and out on the 15-minute, the intraday, the 1 minute, that kind of stuff than it is for, all right, well, I'm going to hold this for 3 to 5 days. So you got to be a bit more flexible. You have to understand that. Okay, I know that is not what a lot of you want to hear, or at least some of what, you know, some of you want to hear, but it's just the basic fact. Okay, so let's get right into the technical now. What was I going to say? There's something. Oh yeah. I was going to go strictly into the charts and do a lot of charts this week, but I did learn that actually I will probably be presenting in 2 weeks. I might be actually presenting in 2 weeks. So at that point, I'm going to actually go over some of my trades and go through my thought process and why I did it, both successes and failures. All right. I know you guys are sick of seeing only the good trades, right? So I'm going to show you some successes and failures, but I want to kind of prep you for that and go over, you know, the basic theory instead of just starting to go like, okay, well, this crosses this, and at this price point you do this. So we're just going to cover the foundation of where my thought process comes from. Okay, so the technical. Sorry, I had to mute. A little cough there. Now, what I mean by the technical, these are the simplest ones, and what most people are really looking for, right? Okay, the areas of interest that I always talk about. Now, if some of you are coming in and you haven't watched my previous videos, there's probably going to be some things that I discussed that you're just going to be absolutely lost on. But fortunately for you, it's recorded, so you can always come back after you watch the foundational videos and check it out. But when I talk about the technicals, I mean, you know, the stuff on the chart, the stuff you can visually identify and measure and draw on, your areas of interest. You know, your quarter points, your larger moving averages, the price points, the sweet spots in the quarter points, your trapped volume over there to the left, you know, stuff on the TDI. Now, the first sign of divergence is one of the things I'll be talking about that I like to wait for. Perhaps a second close over the signal line. That's actually an old school thing. That's not mine. One of the things that Steve originally talked about was waiting for it to come inside the bands, then go back outside the bands, then come back inside the bands, because, you know, if it extends down another level, that's going to help you. You know, when you get that second leg, that first leg usually occurs when it comes back in the signal line through the bands, and then you just get out there, and all of a sudden, well, you grabbed another, or you could have grabbed another 30 pips on the way back down if you waited for that second exit outside of the bands. Not always, but it's something to consider. And, of course, method-based parameters. Now, you could consider this technicals as well, but, you know, this is, you know, your 2.5 to 3 times ADR, your 3 levels, you know, visual, actual levels, and your behavior of the price, which is actually the third category, so I'm not going to diverge into that. So that should be fairly self-evident, right? All right. What about the behavioral? Now, when I say the behavioral, I don't mean your behavior. That all falls under the mental and the emotional, which is the next category. But what I mean is the behavior of the market as I talk about. You have to consider in your how long am I going to hold this kind of thought process, the phase. That's why I talk so much about, you know, the phases of the market. Are we range bound or are we trending? And depending on that behavior of the market makers and what's going on in the market, that's where you can go, all right, you know what, I can only expect this, or I should only expect this, or I have to kind of, you know, pare back my expectations, as opposed to, well, hey, you know, I'm looking to the left and there's nothing there. It's maybe I can hold this for 500 pips. And then start to look at some of the other stuff along the way to kind of keep you in. So that's one of the things you have to consider is the phase of the market, but also the actual price action, which back to what I was talking about with the levels, the 3 levels, 2.5 to 3 times ADR. We all know about that, but also visually, not just 2.5 to 3 times ADR. I see this a lot. You know, people be like, oh, well, you know, I didn't take it there. It wasn't 3 times ADR. It was only level 2. Well, the more you study the higher time frames, you'll see that, you know, a lot of times the middle of the larger structure is in level 2. The 50 just crosses the 200. It does some jerky behavior before it heads back towards the first leg from 2 weeks ago or a week and a half ago, whatever. So this, I mean, that requires a lot of chart time. And that includes homework. That doesn't just mean sitting around, like, you know, trying to trade a demo, trying to get, like, quote-unquote experience. It means a lot of the historical chart patterns, like looking at them, going through, and getting used to seeing, like, wow, this is one of those things that, you know, Doug or Steve or whatever was talking about, you know, for example, a 2.5-day cycle, you know, only a 2-day cycle. You get 3 visual bursts, but, well, the 13 crossed the 50, but that 50 didn't cross the 200. How come we're going back down? Where's level 3? Level 2 didn't even happen. So, you know, you got to remember, it's not, everything's not set in stone. It's completely dynamic, and they're basing all their decisions off of what? The money, okay? Oh, I forgot to give you guys the quiz that I give all the time. Oh, well. Hopefully you guys know it by now. All right. But slow versus fast, that kind of behavior, you have to consider that as you're holding on. Slow move is the true move, you know, fast false. So one of the biggest indicators during a trend is wow, it's so overextended. I mean, look at dollar Swiss and dollar yen right now, and it even got me in trouble a little bit because we just came out of a lot of range-bound behavior over the past 6 to 8 months, and all of a sudden it's just trending, and it gets you in this mindset, and you're like, oh, this is the top. No, this is the top. No, this is the top. So, oh, excuse me, 1 second, got to mute. But a lot of the behavior can be interpreted via the speed, how it's riding along the moving averages, that kind of thing. So that's one of the things you have to be aware of. And also how they're actually handling 2TL, which is, that's to the left. That's one of my little abbreviations, which refers to the trap volume to the left. So especially once you start moving away from a peak, you'll start to see these failed patterns or continuations. And that's a big part of it for me. And I'm going to elaborate more later on, but you've probably heard me discuss that in some of my presentations, the failed patterns, because you got to remember, when they're going down, when they're truly going down, they have to show up. And when they're truly going up, they have to show down. And they'll do that by creating those little M's and W's that fail all the time, which has gotten most of us in trouble as we progress through the method, as we learn the method. We're taking just M's and W's over here. Ooh, there's a W. Those failures are what get all the other retail traders who are trying to take continuations, because they just watched the trend go up for 2 weeks or a week and a half. Now they're convinced it's going up, and all these little W's that they see, they're considering pullbacks, but they keep failing. So I'll talk more about that. But that's what I mean about the behavior, how they're handling price. Okay, I see the little question mark thing. Let's see if there's a question in there. The audio stopped, audio back. Okay, I'm glad. Sorry for that. If that, maybe I hit the little button there. Okay. So the mental. All right, let me just grab a drink of water here. I'll move on to the next slide. You can start reading it. All right, now the mental. This is a big part of it. This is probably the big part of it, because if your mental game, if your mindset, think about it, your mental game isn't up to snuff, then nothing any of us show you is going to be worth a damn, really. So that includes knowing the method, which is the core. Okay, not just that Steve always used to make the joke, like he'd get students coming up all the time like, oh, I could quote your course, and I know it inside and out, and I've seen it a dozen times, and I was one of those folks. But what I mean knowing the method, like the core, the deeper understanding, and of course that only comes from copious amounts of homework and really saying like, okay, this is the core. It's all about the money. The entire business is identifying the peak and trading away from it, and the market maker's entire job is to create a sentiment and act against it. Okay, I know that, and I know the basic setups and the level parameters. Now let me go do my homework and see if it all makes sense to me, and that's what I'm talking about. And from that, you got to gain your confidence, especially in your peak identification. Again, number 3. What's the entire business? How do you apply the method in a single sentence? Identify the peak and trade away from it for 2 to 3 days. So you have to have, number 1, confidence in your peak identification. That's why I talk about specifically several kind of things that I really want to see to truly go, oh my God, this is my peak. Now, get your fingers ready, because I'm going to ask you a question. Yes, probably when I coughed. Thank you, Fatty. How you doing, Fatty? Okay. For those of you that have watched my swing presentations and who also have the, I was going to say pleasure, it sounds a little full of myself, the convenience of being able to attend on Sunday. What are some of the things that I talk about for identifying a peak? What are my favorite things to look for a solid peak? And you can type it one at a time, because I got a couple different things. I only see one answer right now. I'm kind of sad, especially I know Patty attends, and oh, there she is. Yes, Glenn. Exactly. Right, I like to see, yeah, definitely a confluence. Confluence of events is huge. Divergence is right, yeah. Attican, good. Yeah, Tim, nailing it. baseline bounce. I like to see a baseline bounce. I like to see 2 to 3 days. Yeah, Adriano, vectors. I'd like to see the aggression. I like to see some form of aggression. And, multi-day session, MRW, the larger structures, right? TDI, RSI, signal hits outer band and bounces back to market baseline and bounces. Right, good, with the baseline bounce rules. Okay, all right, good. I'm glad to see some of the answers coming in. Exactly, Glenn. Yeah, Glenn's pointing out he's all the things that we just broke down, just happened on a pound this week. And you want to know what? Full disclosure, I missed those. I actually slept through that entire session right into 11 a.m. noon, after all that stuff happened yesterday. Yeah, pound was beautiful this week. I know, it was awesome. But everything was there, right there. I like seeing stuff, quarter points. Another thing that some people didn't mention, and I know it kind of gets overlooked, but I like to look for the 50 pips above or below a quarter point. That the trap throughs of those price points above or below. Now, I also like the intersection of the moving averages with those price points, with those quarter points, and those sweet spots. We'll get more into that, later, but I've covered it, quite extensively. Yeah, exactly. You could be writing all night with all the confluences, but my primary ones are, and this is taking from the core of the method. I want to see that strong 3 bursts. I want to see 2 to 3 days worth of divergence. I want to see, do I take smaller peaks that, it occurs the M formation, for example, happens in a single day? Sure. But usually that single day M pattern that happens the beginning of London and then, it might peak later on in, give me the second leg later on in the New York session. Typically, you look on the H1, that'll be the third push. That little M across 2 sessions will be the third push on the H1, and that day is divergent from the previous day. So that's what I'm talking about. That's why to have confidence in the actual peak identification, that's why I'm very specific in things that I want to see, because it can get confusing when you get a nice level 3 that lasts for 2 weeks. Isn't that right, dollar yen, dollar Swiss right now? I know some people have been having trouble with that. Okay, so I'm going to dock the questions, or we're going to continue. But along with the mental game, you have to have acceptance. And I know this is going to start sounding all wishy-washy, right? And this isn't, I didn't just meditate on this and all of a sudden come to the realization like this. My good friend Mark Douglas, not really, I'm not friends with him, but I love his book, Trading in the Zone. And, Steve and Carr recommended that a long time ago. I think Steve recommended it to the larger group. And it really, man, the dude's inside your head within the first 5 pages, first 5-10 pages. You're just wow, of course, everything. I remember laughing a couple times reading because of how relevant, how uncanny his description was of my mental process. So, he talks about acknowledging the loss, acknowledging the amount that you're risking. For example, you take a trade, and let's just talk about H1, okay? Because your best entries, I screw up more if I try and go down to the M15. It's hilarious. So the H1 entries that I look for, if I'm taking a 40 pip stop, okay, I'm only risking 1%. If I'm taking maybe a 20 pip stop, if there's the shift on the H1 that's a 20 pip stop, I might only actually risk a 0.5%. Why? Because you never want to get in all on the first thing, especially when you're looking for the larger reversals. Okay, yeah, you never spend your whole, what's the term? The kitty, is that it? Yeah, you never want to blow the kitty on that. So when you get into a trade, do you really accept the risk? And what he talks about is that most people say they do, but they don't. And if you get ticked off, if it hits your stop and you're furious, well, then you didn't really accept that loss now, did you? You didn't realize, you didn't mentally accept that, when I take this trade, I know that the market is dynamic. I know this is strictly a game of, or a business of probabilities. So there's a very good chance that I could be wrong. Anything can happen. I could be spot on with every single rule, and bam, all of a sudden a huge order goes in from some fund that I have no idea about, and the market makers are like, you know what, we're going to head on up there. You just don't know. So you have to accept that stuff, okay? You have to accept you're willing to lose on your position. You're willing to say, hey, I'm putting this money down to see if I'm right. That's what Mark Douglas talks about. And then that little carrot there is just saying, we're referencing that line. And you have to accept that you don't know. As I said in the email a couple weeks ago, it's why they call it speculation. We like to call ourselves traders, but really we're speculators, especially if you're doing the swing thing. You have to accept that you don't 100% know, that there is no certainty. And that's one of the most difficult parts of the business, is the uncertainty. It's also the most painful. And you also acknowledge that potential profit is not the same as realized profit. That's big. Okay, I know it's number 4 here, but it's big. And you acknowledge that pullbacks are part of the market. It's part of your strategy. Those bottom two, while seemingly kind of innocuous, and it's just like, oh, it's in the list just for a couple extra bullet points. No, that's the big part of it, because it's one of the biggest things that gets us in trouble. It's why you're all here, why you want to know, how do I hold? Why? Because actually, I'm getting ahead of myself. I actually have this on another slide. But remember those 2 bullet points. Take your screenshot, write it down, okay? On to the next slide here. Hopefully, I think. Come on. All right. So in consideration of those last 2, I want you have to develop a new mindset. If you're going to actually swing, you want to try this out, and even if you're an intraday person, look for those perfect peaks and give this a shot. But here's the mindset that I want you to develop. Trade around your position. I know it seems like, what? Trade around your position. Right. I want you to stop thinking about price going against you, as we all do, and just shift your mindset over to a reprogramming of what pullbacks mean to you. Okay, you need to evolve from, I'm giving it back, I had to get out, to, ooh, new opportunities. I can get in again. I can add more. Okay? It seems very simple and very obvious, but, okay, it's the single most important thing to keep in mind, right? That there's no guarantee, okay? There's no surefire in any of this. But once you have the mentality, the core, you know what the core is, right? Let's run through the core before we go any further. We bust out the question pane. Let's see. Patty, don't hurt yourself there. So much text. Okay, so we're going to just review the market maker cycle. What do we know about the market maker cycle? We get a peak. Okay, the peak gets put in. How do we know the peak's put in? Go. These are all rules that Carr and Jim and everybody talks about all the time. They've drilled it into your head. So fast. Okay, people are getting ahead. People are saying 3 times ADR, 3 to 5 days of move. No. We have the peak. It's been put in. How do you know the peak's been put in? And I don't mean all my stuff, the comp plan. I'm talking about the basic core of the method. Like, well, how do you know the peak's been put in? Okay, someone's mentioned the 1350 cross, 50 pips close away from high a day. Okay. Move 1 ADR from peak. Okay. Okay, yeah, right. The overextended TDI, good. You're seeing divergence. All right. Now, what do we call that? When all that stuff lines up, the peak has been blank. The peak has been, okay, locked or, right, it's locked in or it's anchored. That's the other word. I'm not going to keep going until you, I'm not just going to stretch that out. So, all right, we got the anchor. Right, 1350 cross, it's closed a certain amount away, all that stuff, it's anchored. Then what do we have? What comes, for example, what's the next setup that we're looking for? Okay, safety. Right, we are looking, yes, AFP. AFP is, okay, what's one of Carr's favorite things? H1. Right, the H150 band. Right, okay. Then we go into what level? Hey, Jose. Well, we're in level 1. We've already been anchored. We're in level 1. Right, right. We're going into level 2. And then Carr comes in and he says, in level 2, you expect what? MW off the Mayo, etc. Okay, so, and I'll stop there. But I can see, I mean, this is a great example. You all know what to look for. It's just that you don't have the confidence in, do I really have to peak? Isn't that right? Like, what is stopping you from getting in at the peak with all the confluences when you see? So someone just typed enough flies to last them, the next 10 presentation. So you know what to expect if you have that peak. Someone's asking, does level 1 have to take out the nadir or the apex? It doesn't have to. It really depends on the depth of that apex or that nadir. It really does. You're never, in my opinion, sorry, you're never going to get like a straight A. I used to say like, yeah, I want to see it to close past the apex or the nadir. But what are you talking about? Is that like a 2-day W? Is that a single-day W? What about a W that lasts, a week and a half or 2 weeks, and the apex is 95 to 125 pips away? It took it took a week and a half to form. So the smaller ones, yes, like the intraday ones, I want to see obviously close above the apex or below the nadir, but. For the larger time frames, it doesn't have to, because by the time it gets up there, it's probably already in level 2. Anyway, so yes, of course, pulling the trigger with the full confidence is my main problem, someone's saying. And fear takes over most of the time. Of course, absolutely. That's just a lack of confidence, and I'm sorry, I'm going to call you on it. It's a lack of certain kinds of homework. Some people, they do one kind of homework. They don't like the other kind of homework, and I kind of get a kick out of the Steve's charter schools that he does, and he consistently shows that one slide. It was a historical homework, downloading the history, the historical charts, whatever you want to call it, waste of time, this and that, all that, but it's the key to your success. It's what will give you that deeper understanding. Specifically, in my opinion, going through bar by bar and drawing and anticipating and going, okay, here are my rules, let me get in. Because you can trade an entire week that way in like a matter of, 10, 20 minutes. You could take an hour to trade a single week across all the major pairs and get immediate feedback. And I'm going to talk about that more at a much different time. But back to what I'm saying. You guys all know the actual, the steps. And it's great that you guys have that. We never really had all that laid out. We had, 2.5 to 3 days of rise, but it could be a 5-day cycle, could be a 3-week larger structure. Well, actually, I mean, we never really got into the multi-week larger structures, but let me actually go back to that slide. So once you've gained that confidence in your peaks, you have to be able to identify that peak and then know, okay, cool, I got the anchor. Once you got that anchor, the pullbacks now mean to you, I'm anchored. I got in after the close over the 13 on the H1. I'm already up 60 pips. Tomorrow, I know I might be only up 20, but that doesn't mean crap, I gave it all back. That means, cool, I get to add on to my position. That's what I mean about the fundamental shift in your mindset. That's going to be your biggest asset, okay? We're going to be talking about some of the technicals, but that's going to be your biggest thing, because no matter what rules I give you, Carr has given you guys how many rules for all the different trades. He's got his 5 basic rules for the confirmed Fs and Ws, and then he has some ancillary, not ancillary, but additional rules for, like, okay, you know, for the half a bat, you got this extra thing, and on a 50-50 bounce, or ID 50, ID safety, he's got a little extra here, like, this is how you handle it. But I know, first of all, a lot of you have been killing it. That's amazing. I'm loving seeing all the trades get posted in the Sunday group, but check it out. I also know a lot of you are booking like 5 and then closing out. You're getting scared out, right? I know. You know, you book 5, or maybe you're up 10, you let it come back, and then you booked -3 because it did a pullback that it didn't do the pullback on the first candle like you were expecting, but it did it a couple candles later, and now you got scared out because, well, I thought it was supposed to happen on the next candle. That's why my pending was there. So, right, exactly, yeah. I'm seeing some people laughing here now. The fear comes from not knowing. So once you know, once you guys have this stuff ingrained, right, all of a sudden, if think about the confidence that comes with that, with being able to identify your peak and have confidence and knowing, I got the peak. The next day, I'm just waiting for. Go ahead, buddy, come back. Just give me another opportunity. Get it in at a discount. That's all it means. That's all that stuff means to you once you have your confidence in the peak. How do you place your stop loss when you swing? We're going to get into some of that stuff, and I'm going to cover more of the stop loss placements when I go over some of my trades not next week, the week after. Let's say I caught the peak of G yesterday and closed that at plus 25. And that happens. Until you start to really study in terms of the swing and some of these rules, then that's going to happen. Excuse me. When my stop loss it's too big, what do you recommend? Take half lot position or leave it? In my opinion, there's no such thing as a stop loss that's too big. The only thing that's too big is risk. If your stop loss is 100 pips, like look, if you just took, for example, all that crap that happened, you know, during the election, if you got that on the pullback and you had 100 pip stop loss at 1% or say 2%, I'm going to talk about adjusting that the deeper you go. Look where it would have gotten you. But if it went all the way against you, that's still only 1 to 2%. But people kind of get panicked and they're like, oh, well, 60 pip stop. And what if if it's a 60 pip stop and it's a clear shift and it goes for 250 pips, okay, you're still getting 4 to 1. Now, the swing trading is primarily, like, I know of the huge interest for it is for a lot of people that have the day jobs that they can't be in front of their computer all the time. And even for you people that can, you can still benefit from this, but what I recommend is finding a hobby that once you enter, you can leave, because you will ruin yourself by sitting there and watching. If you spot a perfect peak and you get in and you're sitting there watching it, you will get out within 20 to 30 minutes most likely, because it's going to do some wonky stuff, because that's their job, and you're going to be down in the 5-minute and the 1 minute watching every little tick, and you're just going to psych yourself out, doubt yourself out, and you're going to close out, and then the next day you're going to see you would have been up 200 pips. Okay, let's move forward so we can actually take a look at some charts. All right, now with all that being said, trading around your position, like thinking in terms of, hey, I got the peak, now accepting that the peaks have been put in and accepting that the next move is a bounce off the H150, so accepting that the price is going to come back and realizing that technical profits, you know, unrealized is different than realized. You're not actually giving anything back, and that, you know, having faith in the system, it's going to go even higher. You can just get in a little bit more. Another thing is book some profits along the way, but the single most important thing to keep in mind is that none of it, there's no guarantee, there's no surefire. Okay, that's why I prefaced with all these different, like, okay, these are the disciplines and things you have to consider, because I always know, like most people, how about on this cross, and what about this? And they're looking for the exact technical indicator signal. If it was out there If there was the perfect pattern, it would have been discovered already. Like the person would be the most wealthy person on the planet. All right. But I will give you some hard, fast ones to consider, ones that I consider in my thought process. And there we go. Okay, so some general guidelines, and then we'll kind of close out and get to some charts for a couple minutes. Only confirmed peaks with multiple confluences and level 3 behavior. There's your confidence. You want very selective on your peaks. Book some profits along the way at the key areas of interest, and the ones I focus on the middle structure. If it's a deeper structure, if your intraday peak, okay, it has everything. It's 50 pips above the quarter point. You have the divergence. The second leg is on the baseline bounce. But you know what? The nadir is like 30 pips deep. I'm not telling you to take. Most likely the shift candle will actually close right below that nadir anyway. So you skip that one. But then you're looking, okay, what's my major EMA? Oh, I got a 200. The mayonnaise is 80 pips away. Cool. Everything's lining up. You're fairly certain you got that peak. Why don't you book some profit at that mayonnaise? Maybe take off 20% or to even 10% at the 50 just to relieve some stress, just to give yourself that pat on the back and lock in something. All right. Other areas, potential zone flip areas. Okay. These are areas where you may have a beautiful peak, but you may be in a longer term trend. So it might just roll up 150 pips to a zone flip area. So look at that. Maybe you want to take off most of your trade at a potential zone flip area. It might not even zone flip, but a lot of times they'll still hold out there and they'll be jerks. All right. But also the trap volume. Look to the left. You see trap volume. You're in range bounds. Cool. It might go past here. Let me take off. Let me take off up here. So booking profits along the way. It doesn't have to be like, okay, take off 90% and let 10% run or anything like that. But you have to find your comfort zone. All right. Some people can take off 80% at 30 pips and then let 20% run for the next 100. That you might be like, I can't do that. Like if I get good at, if it's running for 200, I want to take off 30% and let the 70% run. Whatever your threshold is, do that. But again, trade around your position by looking to increase your position at the accepted waypoints that we talked about, that that I didn't even need to really talk about. Hold until you see. Now here's one of my things. I want you to start looking at the 513 cross. Does anybody remember that from the original course back in the day? The 513 cross? No? Okay, the original course, Steve used to talk about one of the confirmations was the 5 EMA crossing the 13 EMA, and he had the arrows. It's still in the indicators. The multi-MA that everybody uses, it has a little where you can turn the crossover arrows on. And I for the longest time, I turned off the 5, and I never. It's the mustard. Yes, on the H1 or the H4. Right now, I'm talking about the H1 right now. I want to focus on the H1. I think it's the better time frame that you can look at for your entries. You can trade the H4 with the same concept, the same methodology, but we're right now mainly the H1. So what I mean by this is when you get a peak and you're trading away from that peak, one of the things I will look for, aside from the other stuff, the trap volume to the left, okay, is there a quarter point? If I'm up 200 pips, all right, and I'm in a range-bound area, and I still haven't seen any divergence plus the 513 cross, I'm still going to book anyway. I'm looking to go for anywhere from 200 to 300 pips, sometimes up to 5 if there's a very strong trend, but in the smaller moves where I start to notice divergence happens, where it's starting to diverge, and I get a 513 cross, and we'll take a look at it. Or, you have a reversal pattern, the M or the W, where price closes above the middle, or hard closes above the water, because sometimes you just don't get divergence and then it goes the other way. So I had to come up with some sort of rules that kind of would like hit all the areas, the sweet spots. So take a screenshot. We're going to the next slide. We're kind of running out of time here. I want to look at the charts. All right. So the pros and the cons, they do abound. This is very important. This is part of the acceptance, all right? You're going to get out early. You're going to wind up giving money back. You are going at some point to scratch out after 3 days and you've paid swap, all right? You're going to miss out on the beginning of a lot of trends, and you're going to miss out on the final portion of a lot of trends. One of my favorite quotes from one of the books that I never shut up about, Reminiscences of a Stock Operator, great read, is one of the most helpful things that anybody can learn is to give up trying to catch the last eighth or the first. These two are the most expensive eighths in the world. All right? And what did I say before? You know, lately I've been trying to go down to the M15 and the even sometimes the M5 to try and tighten up my stops. It's just been biting me in the butt. Why? My thing is the H1. I'm just better on the H1. I see it on the H1, and once I get down to the M15, you know, it starts becoming a guessing game almost. Like, oh, I'm fairly certain in the next couple candles it's going to create that baseline bounce. So when I'm trying to really anticipate on the M15, it starts to screw me up. So that's basically my version. That's me trying to catch the first eighth. So just accept this kind of stuff. Just be, hey, it's part of the business. So, all right. Yes, you're going to be wrong. That's part of the acceptance. Remember the acceptance thing. Okay, I forgot I had these extra ones here. Underline that circlet star and put a number 1 next to it. Acceptance, you will be wrong. And it's okay. All right, final note then to the charts. Think of all your near misses for a moment, please. All the if I only moments. And all those, oh, I should have just statements. Oh, if only I should have just, okay. What do those statements all usually end with? I'm dying to see your answers. No, that's not what I was thinking, Jeff. Jeff and Tim, Jeff, Tim, Phil, you all gave me the same exact answer. That's hilarious. That is hilarious. No, it wasn't that 4-letter word. It usually all ends with waited. Am I right? Oh, if only I waited. Oh, I should have just waited. And that means with an entry or an exit, right? Oh, because you're getting in on the first leg. You're not waiting for the second leg. You're not waiting for the confirmation. Or once you do get in, what do? They pull that garbage that scares you out that Steve, talked about. I remember he gave that one chart example one time where he was drawing. He's like, they'll pull away 20 to 30 pips, but then they might pull back 15 pips, or they'll only go up maybe 20 pips. They pull back 15 pips. All of a sudden, you're only up 5 pips, and you get scared, and then they come within 2 pips, and what do? You close out, and it turns out that was only push 1. That was only level 1 of the intraday, and then it just goes up. And I know you've all been there. I know. That's the entire story of the day trader, of any trader, really. They pull their garbage, and even though you're in, you got in, you follow the rules, you're in the right entry, they start making you doubt yourself, and you wind up clicking. And usually, how many, come on, show of hands, how many people not 1, 2 candles later? If only I waited. Okay? So, yeah, everybody. Yeah, me. Yep, exactly. So, that's why I'm talking about, like, you have to be able to sit on your hands. And I'm going to end with this quote here from Larry Livingston from Reminiscences of a Stock Operator. I've mentioned this before, but it's important. He said, it never was my thinking that made the big money for me. It was always my sitting. You got that? My sitting tight. It's no trick at all to be right on the market. You always find lots of early bulls in bull markets and early bears in bear markets. I've known many men who were right at the exact right time and began buying or selling stocks when prices were at the very level which should show the greatest profit. And their experience invariably matched mine. That is, they made no real money out of it. Men who can both be right and sit tight are uncommon. Okay? So, with that, let's take a look at some charts. Let's see. Now, you're going to see a couple things on the charts that you might be like, whoa, what's that? For example, I keep the 150 on my H4 chart, okay? And the yellow is the 5. Now, I don't use the crossover arrows just because they tend to, from my eyes, my preference, they tend to clutter up the chart. Okay, so we're actually on the H1. Let me go down to the, or we're on the H4. Let me just go down to the H1. So 2015. Oh, no, take a look at UJ. All right, it doesn't quite work out because we get scared out, right? How many people are just holding it here? It closed back up over the 13, a huge pin to the mayonnaise. We've been up. Who knows? Different that I actually like to look for in certain places, a big pullback towards the peak, especially if there's aggression shifting away from the peak. It's kind of a nice thing, and I'll show more examples at a different time of that specific. You start the week looking, you see a fall week beginning back up into this area, you see the bursty behavior, and then it starts to roll over. Okay, so let's say you're looking at this, and you see this little baseline bounce over here on the second shoulder. You get in. So what are the rules I'm talking about? Okay, you're in. Now, do you freak out because it's now hitting the male, or do you look at this and you say, well, there's the 1350 cross. What am I expecting? I'm expecting the 50 H1 bounce, the H150 bounce. Let me trade around my position. Okay, I'm already in. Now let me get in some more because I know the cycle. I've studied the cycle. Carr and Jim and Doug and Steve have just drilled all the different waypoints into me. So I get in. All right. Now, where do I start getting out? Start applying this new rule. I want to see divergence and what? I'm looking for divergence plus. Now, if you all took a screenshot of those rules, I don't know. I just said it was on the slides there. Those hard, fast rules, or the general guidelines that I like to, right, thank you, Patty. The 513 cross in conjunction with divergence. Or, and this is why we take screenshots, because I'm gonna always start to refer to stuff I just talked about. All right. Either the 513, well, aside from the prices, I meant those general guidelines. If I'm rolling out of here, I don't want to take just the quarter point. Now, yes, I would have scaled some out at the quarter point. Why? I got the quarter point next to where they've been stopped. They've been creating this wall of price here at this quarter point, plus the blueberries coming in this area. So I'm going to want to book some profits here, but I've already scaled in here. All right, I have my baseline bounce, closed over the 13, second shoulder. After the head was a false move week beginning, rolls over. The 13 has never, or the 5 never closed over the 13. This is why I use the 5 over the 13, right? What's one of the rules for getting out of one of the 15-minute trades? Like if you take your entry and price closes where, you scratch, you get out. Anybody? Right, over the 13. Good job, Sarah. Bella, good. Right, if it closes back over the 13, you get out. I don't want to do that for the swing trades because why? Look at that. Well, okay, I enter on the 13 here. Let me zoom in a little bit for you. There you go. That's better. Thank you, Doug. You're welcome. Okay, it closes over the 13. Well, what then? That it doesn't really work as well for doing the swing stuff. Okay. Plus, you're expecting that 50-50. Okay, so then you close out here, or you close out here. No, that's why I wait for the 5 crossing the 13. Right. When you're swinging, you're expecting these pullbacks, so you have to deal with it closing over the 13. If you let it go until the 5 crosses the 13 divergence, you'll be able to stay in longer. Now, what other rules? And then I'm going to have to end it here. I promise next time I'm going to be doing all charts, all right, because I've covered everything that I want to cover, all right? So in that slide, what did I say? Let me pull it up one more time. Before we take a look. Where did it go? Or you have a reversal pattern, i.e. an M or W, where price closes above the middle or hard closes above the water. I'm going to want all you guys that are really interested in the swing stuff and being able to maximize the crap out of your entries, you got to rewatch this video or take a screenshot right now, all right? We're going to go back at the charts and look and see what I mean, because this is a great example of this. Here is, that's not divergence. Now, I'm not going to get out of here because I want to see divergence, and we know from experience that typically you're going to get a second leg. However, there's no divergence, all right? Now, here's where it gets a little tricky. If I see this close over here, I'm done. Why? This closed over the water, this closed over here. But Doug, it went all the way down. I don't. Well, yeah, you have baseline divergence. Yes, you're starting to get some baseline divergence. Not too much actually. You start to get. No. I'm using this as an example to show you the second. I don't care, even if I get a wider W like this, and anytime it hard closes over the 13, price closes over the 13 plus I get a cross, you could choose that to be your variant. But you'll see the reason I don't do that is because a lot of times the W's will fail right here, and it will continue going. Right here, Sam. Continuation. It's not what I like. It's not really, because I mean this is higher. If this was lower, I would consider that continuation divergence. But it is the shark fin right here that is another option. If there's no reason you can't learn how to get back in on this. But so what? You get out here. Let's say you get out here. You've also scaled out here even more. I'm booking some profit there. Okay. I'm sorry. Somebody's saying the sound is going out. So, all right. I wanted to show you this example just to give you an indication of what I'm talking about. And yes, this next head and gotten in here, you've scaled in, you've booked out over here, maybe you even booked here because, well, hell, it's at the blueberry. Then you see a massive drop. This was way overextended, the ADR. You decide, you know what, it stopped like 5 pips from that sweet spot. I'm going to book like 80% of everything, and then if it starts doing some continuation stuff. Maybe I'll add on. Trading around your position. I don't care if I'm going to get out here. Why? I've booked a lot of extra profit, and as someone just pointed out, look what starts the next week. Boom. Baseline bounce, head and shoulders, 50 pips above the quarter point. What are you talking about? Oh, the quarter point's way up there. Here's your quarter point. It's above the quarter point. The second shoulder, shift, baseline bounce. There's your entry. Now, what are we looking for? What? Okay. It's bouncing on. Is there any divergence? No. Has the mustard crossed the ketchup? No. Shift up. Book at the quarter point. Wait for your divergence. Where's your divergence? Your divergence is over here. 13 crosses. You're out. You're out before all this. All right. We're going to cut it there. But someone else is saying no sound? Right. That is a very beautiful head and shoulders. Okay. So, yeah, the sound is getting choppy. I'm 10 minutes over. I apologize to everybody. I was trying to keep it to 50 minutes. When you're moving your chart. Okay, so I want you to rewatch this, okay? Oh, you're very welcome, Tim. Thank you. Thank you as well. I know I'm sorry, I didn't get a chance to really take very many questions, but I hope everything was actually rather clear. I didn't really, as far as I'm concerned, leave a lot that was ambiguous, but I'm going to be coming back. Thank you. Can you send me the link for the W? The W. All right, thank you very much, Glenn. Okay, so we'll leave it there. Come up with questions. You can always email me the questions at btmmswing@gmail.com, but I will see you in a couple weeks. Rewatch this video, study it, look for what I'm talking about, and see, practice on the hard right edge, and utilize these techniques and see how much you can maximize your profits by just adhering to some simple rules like this. Okay? So, Car's going this Sunday. So I'll be actually on the Sunday before the next presentation that I do. So, Jorge, you'll have to email me. I'm not sure what you're talking about, the link for the W. Email me and explain. But thank you so much, Frank. All right, thank you, everybody. Really appreciate it. I look forward to seeing you next time. You Sunday folks, I'll see you on Sunday. Thank you, Glenn. All right, have a good night. And God bless, Phil.